Good morning. Welcome to Core Services and our Core Belief series, Why It Matters. Today we're going to be discussing recognizing revenues accurately. I'm John Coggle and I'm your host for this episode. So a little bit about Core before we get started. We are focused on audits and review services of condos and HOAs, and we also offer advisory services to the board to assist the board in the performance of their oversight duties. So getting right into it, revenue recognition rules are pretty straightforward. They're similar to commercial entities, except for when we're really talking about the fact that the assessments are a commitment by the owners and they're going to be due and payable essentially upon assessment. What the revenue recognition rules do require, however, is that if you issue monthly financial statements, then you should try to apportion that revenue over each one of the months just so you could recognize the revenue on a periodic basis. When it comes to special assessments, it does matter what you're trying to do with that special assessment. If you're, say, taking out a bank loan to address the fact that your reserve has a deficit and you need to spend $2 million, and let's say you only have $1 million in the bank and you need to borrow that other $1 million from the bank, the owners have an obligation to pay that $1 million plus any interest. And so what GAAP requires you to do is make sure you match the revenue to the construction draws, the expense for the revenue project, and also recognize the fact that since these are likely going to be over a 12-month payment window, interest should be charged on that amount that's still due from the owners. If it's merely to try to catch up a reserve, or perhaps it's a special assessment for the operating because your operating expenses went over budget, it should be treated as revenue when the assessment occurs. And as provided it's paid off under 12 months, you wouldn't have to charge any interest. So there are other revenue sources that most associations have. They charge fines to the owners. And with fines, one of the things to realize is it should only really be treated as revenue when the final appeals have been exhausted. So an owner who gets a notice of fine for a CC&R violation, if they have the right to appeal it, until the board hears that appeal and makes a ruling, it should be held off until that final ruling. It keeps you from having to go in and make adjustments to your books for uncollectibles or estimates for appeals and all that other stuff. Just don't recognize it. It's considered a gain contingency. For user fees, obviously if somebody's using a space like an RV space and you're going to charge them for the month for parking there, then you've earned it for the period in question. So and the only thing you have to be careful of is if you're charging a deposit, that deposit is actually a liability, not revenue. And if you're a condo and you have rental units, you actually have tenants in that are staying there longer than the 30 days for the short-term accommodation or transient housing rules, the rents are earned when over the course of the months that the tenant is in the home. And security deposits are also, again, treated as a liability because they're refundable. So when we're talking about the revenues, we're also talking about the matching of bad debts and the allowance for uncollectible accounts. You should always look at that at least annually. One method is to do it as a percentage of the assessment. If you can look back over your history and let's say you recognize that 1% of all your assessments probably aren't going to be collected for any reason, you should just make the allowance at that point in time. It's what's known as recognizing the bad debt based upon the revenues. And then the other way is you could wait to the end of the year or some other quarter end or any method you like and evaluate it through the aging report. And I have a few examples coming up here for that, but all you'd be doing is looking at it and saying, hey, if I have a lot of receivables that are past 60 days, they might be more challenging to collect. And so you'd have a higher percentage of allowance set against those longer term receivables. Under the special assessments, you're actually looking at what's known as performing receivables and non-performing receivables. And a performing receivable is basically someone who is essentially current on their payments, and a non-performing receivable is someone who has stopped making their payments. And there are obviously rules for that. For instance, a non-performing receivable, you really should not charge the stated interest rate. If you have a default rate, because they're technically in default, you should be charging that rate. But more importantly, even though you might be charging a higher interest rate, if they're still not making the payments, you probably aren't going to collect that interest when it goes to time for filing the lien and the foreclosure. So there are obviously two different risks at hand here. When you're looking at the performing receivables, it's really a percentage of that assessment just over the term of it is going to potentially go bad. So you want to keep that in mind. So what we have here is the assessment and method. Again, this is simple. 360,100 units, condominium, and you assume in this case that the bad debt is about 1/2 of 1%. Calculates out, and you can make it all at one time right up front, or you could basically break that $1,800 down over the course of the 12 months and post $150 each month. Or you could wait, look at it at the end of the year, and then make the valuation adjustment against it by looking at it and saying, look, we know that anybody who is basically simply a few days behind because of the timing thing, 99% catch it up. And so you could apply those percentages across, and again, anybody who say over 90 days, that half of it probably won't be collected, because when you go to the foreclosure, they may be underwater on the mortgage. There may be other liens that have superior rights. By the time you pay off the attorney for going through all that motion, there may not be as much money available. So you look at the total amount that's due, you apply those percentages based upon the aging columns, and you can make your adjustment that way. From a materiality standpoint, as you can see, they're both about the same. For the special assessments, you do the same basic thing. I laid out a special assessment here, and it's going to be collected over 10 years for that $720,000. Calculate out the total monthly payments you receive from all the owners, assuming everybody is making that monthly payment, no one prepays. And you look at it and you say, look, over the course of this 10-year loan, I'm going to have 1.5% are probably not going to pay in full. The other thing you'd look at is if somebody goes into that non-performing column, what's the odds that I'm not going to collect any of it? So again, when you start the special assessment, you have nothing but happy thoughts about everybody. Everybody's agreed. They've all voted. They all make their first payment, and you go, we're not going to have any non-performing assets. So you take that 1.5%, multiply it by the special assessment, and you recognize that $10,800 bad debt along with the allowance. The problem is, after a few years, you start looking at this, and now all of a sudden we're looking at it and we're saying, hey, what we have here is we're down to $450,000 of that current performing, and so its allowance is about $7,000, but I have $25,000 of non-performing receivables out there. People were not making their payments. Well, half of that is 12, and when I add those two together and I compare that to that original allowance, you could be short. And we catch a lot of this on audit, and this becomes a challenging conversation sometimes because people don't really recognize that that's a problem. So again, make sure you set it, and then you go back and evaluate it based upon whether people are making their payments or not. So anyway, I hope that's been helpful. Anytime, feel free to go out to our website, core-acct.com. Feel free to click on the contact and send us a question if you'd like, or you can contact us on Twitter, or you can find us on LinkedIn. Thanks a lot. I hope you have a great day, and I hope this has been very informative for you. We look forward to our next episode with you.